Cash feels comfortable. It's liquid, it's stable, and lately it's even paying 3 to 5%. But here's the problem. Cash is not an investment strategy, and treating it like one, that could be quietly one of the biggest risks to your financial future. I'm David. Welcome back to the channel. In this video, I'm going to show you the numbers behind that statement, the opportunity cost, the impact of inflation over time on your wealth, and why staying safe on the sidelines might actually be more expensive than you think. Okay, so first, let's talk about why cash has such a strong emotional pull. I know cash feels safe. It doesn't bounce up and down like the stock market. You can see it in your account, it's liquid, it's accessible, and you can access it whenever you need it. And that feeling of safety, it's powerful, it's appealing, especially when markets are volatile. Here's the problem, safety is a feeling, not a fact. And what we're talking about is not cash in the bank. You know, if you go back and watch some of our previous episodes, we think, 6 to 12 months of savings is good. We're talking about cash and retirement accounts. Because while your cash balance doesn't move, its purchasing power absolutely does. Let me explain with something you experience every single day. Think about the groceries 5 years ago versus today. Think about gas prices, healthcare costs, housing, coffee. Everything has gotten so much more expensive. That's inflation. And inflation is like a silent tax on every dollar that you hold in cash. While inflation is running at 3% per year, which it has been recently, every dollar you have in cash is losing 3% of its purchasing power. Your bank account might say you have 100 grand, but if inflation is running at 3%, that 100,000 can buy you less next year than it actually does today. That's actually not safe. That's actually another form of risk. Now, let me show you something that really drives this home. We use this chart in our seminars, and it's based upon decades of historical data. When we look at long-term performance of different asset classes, here we have a chart, and it's essentially returns of the S&P 500 going all the way back to 2005 through December 31st, 2024. So that is a lot of data. It's a lot of market upturns and downturns. It factors in the Great Recession. And this is essentially saying we're taking $10,000 and what are the different outcomes below. So someone that's fully invested from January 3rd, 2005 to December 31st, 2024 in the S&P 500, that $10,000 had averaged a 10.4% rate of return over that time period. But what if we miss the 10 best days of the market? Now that return down to 6.1%. What if we miss 20 best days? Now your return over that time period is 3.5%. What if we missed 30 of the best days over that 19 years? Now your return is 1.3%. What if we miss 40 of the best days? Negative return. 50 of the best days, negative 2.2. And if you miss 60 best days, negative 3.7. We see this happen all the time. Markets are volatile. People pull out their money and they sit in cash because that's safer. But now what's the problem is you're stuck because you don't know when to get back. And that money sits in cash. Now, if you look back to April of this year, the market's dropped anywhere from 10 to 20%. The S&P 500 has dramatically grown since the bottom of April. So if you're sitting there in cash, or cash is your investment strategy, you're missing out on significant returns over time. And you can see that right here with this chart. I think obviously in moments when the markets are volatile, cash is going to look like a better place. But if you have a well-written plan, a plan that covers how much you should have in your protection bucket, which is cash, your income covered, and then money that should be in the market for long-term growth, you should never be trying to time the market or worry when markets are bad, then you go to cash because that's when it's too late. So if your strategy is just sit in cash, you're not being conservative, you're being backward looking. You're accepting guaranteed losses to inflation in exchange for feeling like you're safe. That's emotional and that's a bad trade. All right, so let me break down the specific costs of holding too much cash. Miss compounding. Every year you're in your cash, you're missing the opportunity for real growth to build on itself. And that 20-year example that we showed you earlier shows you, a good historical period of what the S&P versus cash can actually provide you. Money in investments doesn't just grow in a straight line, it compounds. Cash, it grows linearly, if at all. You never catch up. And cost number 2 is the emotional trap. This is a big one. I see it all the time. Markets drop 15 or 20%, like April earlier this year. What happens? People panic. They sell their investments and move to cash thinking, I'll wait for things to calm down. Then the market recovers. Again, this year is a perfect example. The S&P is up significantly from April lows. It goes up 25% and they're sitting in cash the whole time, missing the recovery. Now the real stress is, when do I get back in? And by the time they feel confident enough to get back in, They've locked in losses and missed the gains. Psychologically, holding cash during a downturn feels safe, but financially, it's one of the costliest decisions anyone can make in retirement. And the third cost, it's a false sense of security. Cash feels like it has no risk, but that's only true if you ignore inflation. The real risk of cash is inflation risk, the guaranteed erosion of your purchasing power over time. And unlike market risk, which sometimes happens, inflation risk is always happening. And cost number 4, if you're just sitting on too much cash in your savings account, like again, we like 6 to 12 months of emergency reserves, but if you're just sitting on too much cash, then you have to deal with taxes on interest income. And even when you earn interest in a savings account or money market fund, that interest is taxed as ordinary income, which could cause you more taxes in your tax bracket. So if you're earning 4% in a money market fund and your tax bracket is 22 or 24%, you're actually netting less than 3 after taxes. Now factor in inflation, and now you're making less than 1% in real after-tax inflation adjusted returns. You're losing money in real terms. It's just happening slowly enough that you don't notice it. There is a role for cash, and we're not saying that cash is bad. It's just too much cash in retirement plans, too much cash over, 6 to 12 months of emergency reserves, or any large purchase coming up. It could be devastating. And cash has a role in your overall plan, but cash should be your safety net, not your growth engine. And here's what I mean. You should have enough cash for emergencies. We recommend anywhere between 3, 6, and 12 months of expenses in liquid cash. That should be your safety net. Plus, any large purchase that you know that you're going to make over the next year or two should always be in cash, because markets are too volatile in a shorter period of time. If something happens, job loss, unexpected expense, health issue, you have cash that you can easily access. And again, of course, short-term goals. If you're planning to buy in a house in the next 2 years, that money should not be in the stock market. It's too volatile. But here's the key. Cash should be maybe 5%, maybe 10% of your portfolio, not 50 or 60 like we see almost in every single day. You're holding a huge amount of cash. You're not being conservative, you're being inefficient, because there are investments and products that can give you better returns in cash while providing stability and reasonable safety. Number 1, bond portfolios, conservative stock allocations, short-term annuities that also have tax advantages. These vehicles can deliver more growth than cash while still being appropriate for conservative investors. The difference is they're actually designed for growth, not to just sit there. So let's go through the key takeaways. So here's the bottom line. Cash is not an investment strategy. It's appropriate for emergencies and short-term needs. But if you're relying on cash as your main holding for long-term goals, it's going to cost you significantly over time. The cost isn't visible in your account balances, it's invisible. It's the growth that didn't happen that's going to cost you. It's the compounding that never occurred. Your purchasing power slowly eroding over time. But it's real, and over 10, 20, or 30 years of your retirement, it can amount to hundreds of thousands of dollars. So if you're sitting on a lot of cash right now, it's worth asking, why am I holding on to this? Is this really serving my long-term goals, or is it just making you feel safe? Because feeling safe and actually being safe aren't always the same thing. So if you're watching this and if you're wondering whether your cash allocation is appropriate for your situation, or if you'd like us to model out what a more balanced approach looks like for your goals, we can help you with that. We can show you different scenarios, different investment mixes, different time horizons, and what that actually may look like over a 10, 20, or 30-year period. Once again, I'm David Afraimi, co-founder and CEO of BAM Advisory Group. Thank you so much for watching another episode. We hope you find the information very valuable. If you're enjoying this content and want more content just like it, click the like and subscribe button. It also helps us get this show, our content, out in front of more people just like you, so they can also get some of this financial education. And if you're wondering if you may have a tax problem, if you're not sure if you have a well-written financial plan, click on the scheduling link in the description to the show and schedule a 15-minute, no obligation, no cost phone call with one of our advisors to see how BAM Advisory Group can help you. You can also visit our website at www.bamadvisorygroup.com and also schedule a call with us as well. Thank you so much for watching. We'll see you on the next episode.